Hey guys, this is Josh from Pro Hustle, and I'm going to talk about post-tax versus pre-tax retirement accounts today. So for these accounts, you pay taxes when you put in your initial contributions, but there's no more taxes after the initial contributions, regardless of how much money you make. Some good examples of this are the Roth IRA accounts. Unfortunately, there are no tax deductions for contributions. On the other side, we have pre-tax, which taxes are initially deferred. You pay your taxes when you actually withdraw the money at whatever age you decide to withdraw with all the capital gains you made. There is a tax deduction for every contribution you make up to a certain amount. And examples of these accounts are 401ks, 403bs, and a traditional IRA account. So I'm going to use an example to try to explain the differences between the two. And this example, we're going to say you had $1,000 that you contributed to each of these accounts. There was no employer match, and your tax bracket was, say, 10%. So here's the two columns for each of the types. I put pre-tax on the left. So the contribution, like we said, is going to be $1,000 for each of these. And the taxes you pay when you're contributing the $1,000, and the pre-tax is going to be 0 because all taxes are deferred. And for post-tax, you pay the 10%, which is $100. Then the tax deduction you get is, let's say, $100 because you're in the 10% bracket, and $0 for the post-tax account. And profit, let's just say you made $3,000 between when you contributed the $1,000 and when you withdraw it at a different age. So the taxes you pay when you withdraw it are going to be, let's say, also 10%, even though that can change. So on the pre-tax, you'd be paying $300, and the post-tax, remember, you paid the $100 when you put the money in, and you never pay again, so that's going to be 0. Put a little straight line, and your net for the pre-tax, the net amount of money you get when you withdraw it will be $3,800, and for the post-tax, it will be $3,900. And this difference is actually going to be larger based on the fact that when you withdraw the money, you're usually in a higher tax bracket. So in conclusion, what do you use? Use both accounts. Just save your money. I would say if you're younger and you're making less money in a lower bracket, I would start with the post-tax because of the potential tax savings. And then the second thing to remember is a lot of pre-tax accounts have employer matches, which is free money, so take that. It really depends based on your goals, but general guidelines is if you're young, try to max out the post-tax accounts first. Please subscribe, and thank you for watching.